We'll tell you a bit more about both of those companies and what we offer later in the seminar. But right now, I'd like to introduce our presenter today, who is Ms. Watchen Harris Bruce. She is the president and CEO of Baltimore Community Lending. And Watchen, I'm going to turn it over to you.
Thank you very much, Bonnie. Thank you. Well, good afternoon, everyone. And we are glad you could join us this afternoon for this brief seminar on understanding financial statements. And I'm not sure what's your level of expertise, what you know or what you do not know. This may be very low level for some, and others it may be advanced. So I'm just going to speak to the matter, assume that this is a refresher for some, and others it's more of a beginning. But the importance of understanding financial statement, it's very important if you're going to be a borrower. Next. So what are financial statements? Financial statements are normally written records to convey the business activities and financial performance of any company. And that company could be a for-profit, non-profit, but bottom line, it is a written statement, and that's what a lender will need in order to determine your financial feasibility. Financial statements are often audited by government agencies, accounting firms, and normally they are done for tax purposes, financing, and investment purposes. So if someone is interested, an investor in you, they will ask you for your financial statements. Financial statements are always written that convey business activities and financial performance of your business. Next. Just FYI, you will have the end of this, you will have the opportunity to ask specific questions. So please take notes of your questions and we will get back to you after the presentation. There are different types of financial statements. I'm just going to focus on three, which these three financial statements are the basic ones. And but before going to that, I just want to let you know my experience has been a business banker. And in my past experience, I've had borrowers coming to me when I asked them for the financial statements, balance sheet, income statement, to evaluate the loans. Some people came to me with receipts in their pockets, mainly construction workers. And they would just put on my desk and say, this is my financial statement. This is what I purchased and this is what I spent. Yes, my receipt. Definitely, that's not a financial statement. A financial statement should be a statement that's in a certain format. And the first one is a balance sheet. The balance sheet provides overviews of assets, liabilities, and stockholders' equity and return earnings. And of course, those assets are what you own. So it's what you own, free and clear. They have fixed asset and as well as current assets, meaning what you own. The liabilities is what you owe other people. That includes your debt and everything that you have to pay back. And of course, your stockholders' equity and it's also your return earnings. Those are your profits at a time, within a snapshot of time. It will, you will know what your net worth is. That's your net worth, actually. And so that could be monthly, quarterly, or annually. So, but it must be data in a specific time period. Next. So going on to a balance sheet. The second financial statement is the income statement, also known as profit and loss, or for short P&L. So if you hear profit and loss, it's the same as the income statement. What income statement does is rather is an overview of your revenues and expenses, and revenue being what you earn. It will show your gross revenue as well as your net revenues. And your expenses is what you pay out during a given period. And that could also be quarterly or annually. And what the income statement does is really gives your company a picture of what the business performance is or has been during a given period. So if someone is asking for your financial statement, they want to know how you are performing during this specific period. Next. And the third statement I'll focus on is the cash flow statement. Cash flow statement measures how well a company generates cash to pay out of their debt during a specific period. So that could also be monthly and quarterly. Usually it helps someone know what cash you need and helps you with planning. Because if you have a cash flow statement, it's just like your checkbook. It shows how much cash you have and how much will be going out and coming in and for what purpose. So that's what a financial those three financial statements I'm going to focus on. So next. So going back to balance sheet. The purpose of balance sheet, as I said, is to show your company net worth at any given time. And it really tells the company what's their financial position. And sometimes when you hear that a company has a strong balance sheet, it means that the company has a strong net worth. In essence, they have a lot of, they own a lot, and their net worth is high, because if it's negative, it's going to show bad. But a strong balance sheet shows the net worth of the company, what's owed and what's what you own. It is also used along other documents, the cash flows and the income statement, to perform financial analysis. So investors use that, as well as lenders and other people who may be interested in knowing about your state of your business. Anytime they will request that from you. Next slide, please. What's included in the balance sheet? As I said earlier, the balance sheet is comprised of asset, liabilities, and equity at the end of the specific accounting period. The assets could include things like cash, investments, your inventory, and those are the investment, inventory, and cash are normally in the current assets section. But property is a fixed asset, meaning it's a longer period. It takes over a year to convert it into cash. These items are placed in order of liquidity. So cash, of course, cash is king. So cash goes out faster. It's like your bank account. It's easier to go to the ATM, withdraw from your cash. But if you have security or investments, you have to sell them, and before it turns into liquidity. Normally those takes a longer time. And of course, property, real estate takes a longer time to convert to liquidity. That could be a year or longer. So current assets easily converting to cash within a year, and long-term definitely is over a year. So liabilities, on the other hand, are the company's financial obligations or debt. It's like all of your credit card debts, which are current liabilities, taxes, current loans, because you could have a long-term loan, but your current portion of that loan is a current liability. Even wages, payroll, accounts payable, those are all due within 12 months. So those are current liabilities. And the longer term liabilities are loans and other investments that are 1 year or longer. If it's more than a year, it will be classified as long-term liabilities. And equity is the amount of money originally invested in the company as an equity, either from you or from a partnership. And your retained earnings are what you earn from the business after the end of the period. It's and those earnings are really what the company is getting as its equity for the investment, taking the risk for the equity. So retained earnings is the goal for everyone. You want to make sure you have a profit, because that's your profit from operating this business. So that's the risk of your equity, but the reward is retained earnings or profitability. Next slide, please.
I'm going to cut in for a second, Watchen. We've gotten a request in chat that we slow it down a little bit. It's a lot of information. So I'm going to request that we slow it down and also let you all know these slides will be available afterwards. And we're also recording it. If you want a recording of it, we'll be able to send that out sometime later today or tomorrow. Okay?
Oh, okay, great. Yeah, I'm sorry, but that's what I told you. I didn't know what's the level of expertise, because some people may feel it's very elementary and others may be too advanced. But I appreciate the feedback. I will slow it down, but you will have it as a resource and reference after the presentation. We will email it to everyone who's on the online right now. Okay, so moving forward, the balance sheet identifies how assets are funded, either as liability, such as a debt, or stockholders' equity. And this data comes from the balance sheet, okay? So when you look at the balance sheet, you will see, that listed. The asset could be something that you purchase, like a vehicle or your inventory, or even a building or some property. But on the other hand, the liabilities for that asset could be a loan that you receive, either from a lender or from a friend or a partnership, putting in equity like an investor. So there are short-term and current liabilities, which are short-term, and they are expected to be paid within 12 months. And the longer term normally are over longer term. Most commercial loans are longer term loans. Anyway, so let's move to the next slide, please. Okay, like we said, items included on the balance sheet. These are some of what's included. Cash, which is liquid asset because they're easily accessible and converted. Short-term investments like treasury bills, certificate of deposit, those are investments that's current. You can liquidate them or change them to cash in less than a year, in few days or months. So those are not long-term. The other current asset are receivables, accounts receivables. And the receivables are the amount of money owed to the company by its customer for sale of a product or service. For example, if you issue credit to your customers and they have to pay back because you need those receivables turned over in order to increase your income. So the receivable, definitely you do not want it long-term. Usually within 30 days, you want your receivables. And if it's going longer than 90 days, it may, cause a problem because then it becomes uncollectible and bad debt. So receivables are something, especially in the retail business, it's something that a small business should pay keen attention to if you are lending your products on credit, because if it's not paid, it's a problem. And that's why a lot of people end up turning customers to collection agencies because they want their bills collected within a timely manner. Okay, so those are on the asset side because it's receivables. Yes, next. Items, additional items on your balance sheet are the liabilities, which are the debt. And that will include also accounts payable. Those are debt you owe someone else. So accounts payable could be something you purchase, your inventory, or you buy from a vendor on credit for something that you need in your office or your store. Those are liabilities. Also wages, salaries, if you have to pay people, those are current liabilities. Everybody wants to get paid, so definitely you cannot hold that outstanding for a long period because they need that. But it's reflected on your balance sheet as current liabilities. Also dividends for those who issue stock. Most small businesses will not issue stock because they are so small, but in terms of I'm just sharing that, that's also an item that may be on the balance sheet of stockholders. So shareholders' equity, which is the last portion of the balance sheet on the right-hand column, is the amount of money that will be returned to you as the investor or shareholder if all of your assets were liquidated. Because when you liquidate the assets, it comes back to you as the investor in this business. So, and that's another way of getting your money back if it's liquidated or is returned to you through revenues from your income statement. Okay, next item. Okay, so let's just pause right there for now, and let me just show you a sample of a balance sheet. Melissa is on page 2.
All right, I'm just gonna stop sharing my screen for a second,
Okay.
and I'll pull up the balance sheet.
Yeah,
I got it. All right, so page 2?
Yes, page 2, please.
Okay. I'm gonna make it bigger here.
Okay, great. It's the next, it's gonna say balance sheet. Just keep going. Go on. Next.
Over here?
Yes, right, that balance sheet. Actually, it's page 4. Okay, great. Now, this is a sample balance sheet. I'm just showing you this as a way to give you an idea of a simple balance sheet. This balance sheet is showing assets, and usually for accounting purpose, it's good to share 2 years. That helps with what they call trend analysis. You want to show the current year of reporting. For example, 2019 and the previous year, which is 2018. So if you look at this balance sheet, it has cash, current assets, which includes cash and cash equivalent. Cash equivalent is anything that's related to cash, like the investments we talk about. So if the left column is 2019, which was last year, the year before 2018, cash and cash equivalent was $1,191,729 and 29, right? And 2018 was 1,001,158. So you see he has an increase in his cash. Okay, so if we go down, you see the different categories of cash assets: accounts receivables, inventory, and then also deferred taxes, prepaid taxes. All of those are prepaid. So the total current asset on this balance sheet is $3.6 million. And on the year prior to that was 4.5. So you see the asset reduced. And that would be something a banker may ask, why did your asset decrease for the last fiscal year? They may ask that question, which is a big difference, almost 1 million. Okay, so going down, the next category is fixed asset, property, equipment, And then also vehicles, all of those are, you have to list your depreciation, because a property machine or equipment depreciates over time. So you will subtract the depreciation to come down to your total assets. So the total asset for this business is 3.8 million. And the year prior to that was 4.7. And as an analyst, that's something should be explained. The variance should be explained why a decrease in your your asset. So let's go down to the current liabilities. The current liabilities show notes payable, short-term borrowings, as well as accounts payable, current portion of accounts payable. Usually when you have a long-term loan, the current portion will be shown on your balance sheet as current, because those are due, like your monthly payment within 12 months, that's the current portion. And then the longer term, the following years, like year 2, 3, 4, and 5, depends on your term of the loan. Those will be long-term notes payable, but the current note payable is listed here. And also your accounts payable, and those payables is what you have to pay your vendors or other people. And then total liabilities is the 2.2 million, 2.0, and then the current year was 2.7. So the liabilities for 2018 or the prior year was higher. And you look at the notes payable, those are the longer term. So total liabilities here is 2.6 for the current year, and the year prior to that was 4.1. And at least that's good, but it still shows a change, and you have to explain that if you submit your financials to a banker or a lender. The last category of the balance sheet is the stockholders' equity, and that shows retained earnings, which comes from the income statement, but your retained earnings, and it shows the total stockholders' equity, and the equity in this case is very strong. It's 1.2 million. That means they have strong earnings of 1.2, and so this is a strong balance sheet. The year before, it was only 583. So that's a big difference also. So you probably want to ask them what happened, what changed. And that could be explained from the activities, from the financial statements, because that's a huge increase in your return earnings. That could be, and you see that the company issues stock to this particular company, issue stock, but usually a small business would not have that. Okay, so that's for the balance sheet. The next one is going to be the income statement, Melissa, but let's hold it right there, and please go back to the PowerPoint. Let me just go back and talk, then we will come back. I'm sorry if you have questions, just note that, and we will come back to the questions, but I need to continue the presentation right now. So we are going back to the income statement now, and you will see the relationship between the income statement and the balance sheet. Okay, thank you. The next, okay, great. Now, what is the income statement, or P&L as it is called sometimes, profit and loss? What it is, it shows the company financial health over a specific period. So that could be 2019, 2018, or 2020 first quarter, or annually. It also provides the company with information about your revenues, your sales, and your expenses. This is very critical information, because the statement is used to make financial decisions, because it will show if you have cash flows at the end of the day. Because the purpose of you being in business is to have a positive cash flow. And as you know, businesses have so many different circles. You start off as a startup business. First, you start just with a concept, conceptual. So from concept, you go to startup. As a startup, you will not have a profit. But then once you start operating your business, you will have break even first. And break even is rated out of your revenues came in and all your expenses is no profit. So that's a break even portion. So the break even just shows that there's no profit, but you have activities. But where you want to be as a business is the next circle of your business, and that's profitability. Because once you have profitability, then you will become more attractive for investments. So after your profitability, then the next circle want to be you are sustainable, because in order to be sustainable, your business must continue growing. And in order to grow, you must scale up your operations, and scaling up is another point in the business growth. And then before you talk about exiting your business. So bottom line is the income statement is important for financial decisions. Both revenues and expenses are closely monitored, since they are very important in keeping costs under control while increasing revenue. For example, a company revenue could be growing or they have a lot of sales. But if your expenses are growing faster than your revenue, your company will lose money, because what you want to do is increase revenue and reduce your expenses, or manage your expenses to not be higher than your revenue. Because if not, you will not be making a profit. Okay, so next slide, please. Okay, what is the income statement? Usually investors and lenders pay close attention to the operating section of an income statement to indicate whether a company is generating a profit. That's what I said earlier. Also for management purpose, the management reports shows quarterly if you are generating enough revenues, as well as compared to people in your industry. The banks look at that, your management company, as well as this is something you should be doing yourself. Because if you are not generating more than your expenses, then you need to restructure your operations to make sure that is performing well and is efficient. Sometimes it is your revenue is lower, but your expenses should be lower too, because once it's higher, then you need to restructure your business. Okay, income statement has revenues from sales and cost of goods sold and operating expenses. Cost of goods sold is really the cost in acquiring those revenue. And for example, it's what did it cost you in a service business? It's what did it cost you to generate this product? Not product, but a service you are offering. And that could include a lot of different things. It could be marketing, as well as all your collateral material. And in terms of retail, that could be things that you make. And even the cost of goods sold is different from expenses. Your operating expense is the daily operating expenses that you pay out to vendors and salaries and other things. But the cost of goods sold is really tied to how you generate the revenue, along with the resulting income or loss. Example of operating expenses are payroll, rent, and other operating activities generated from the business, like your payroll and insurance and core business activities. And things that are non-operating normally relate to your cost of goods sold. Okay, next slide, please. Balance sheet versus income statement. The key differences, right, Adam, it's the timing. The balance sheet shows that a company shows what the company owns. That's the asset, and owes the liability is what you owe or someone else at a specific time. In contrast, the income statement shows the revenues and expenses for a period. It could be a year, but you could look at a balance sheet for today. It's like, what do I own today and what do I owe? So that would tell you at a snapshot of what's going on right now. But usually your income statement has to be a period because it's a different type of financial statement. You want to show either quarterly income statement or your yearly income statement because you need that time to explain how you are earning. It wouldn't be a daily or snapshot. The performance, the balance sheet does not show performance. The income statement shows performance and it shows profit and loss. The balance sheet rather shows your strength in terms of how strong you are, in terms of how solid you are, and healthy in terms of your assets. But performance-wise is your profit and loss of your business. So that's important to know because the first thing people look at is show me your profit and loss statement. And they just want to make sure you are profitable before they even talk to you. So the next next statement, next slide. Balance sheet and income statement also is for reporting. The balance sheet reports, the asset, liability, and equity, while income statement reports revenue. So it's for reporting purpose as well as for management purpose. Okay, it can be used. The balance sheet determines if the company has enough assets to meet its financial obligations. And the income statement is used to evaluate the performance and to see if there are financial issues that needs to be adjusted or corrected. So those are two different uses of the financial statements. Also, creditworthiness. Lenders, as BBL is a lender, what the loan officers will look at is your balance sheet to see if they will extend your credit because it shows that you have net worth or you have something to pledge as a collateral if needed. But if you do not use collateral, they want to make sure you are solid, that you have something to fall back on. But they also use the income statement to determine if your business is making not enough profit to pay its debt. And the profit would be your cash flows because you want to make sure you have enough cash flows to service your debt before taxes. So that's something we will see later. Next slide. Okay, the next statement, the last one I'm going to talk about is the cash flow statement. Sometimes it's called a statement of cash flow or cash flow statement. It's the same thing. It measures how your company or your business generate its cash to service obligations or your debt. And there are different parts of the cash flow statement. You can use it for operating, your operating statement, as operating as well as investing, and as well as it's three parts of the cash flow. What it really does is show how much money you have coming in to service those debt along your operation. Because if you do not have cash, you won't be able to meet your current obligations. So it's a way of doing cash flow projections to make sure you have enough cash coming in to either purchase or invest. Because when you want to purchase something, you have to make sure you have that in your account, similar to your checkbook. Because if you do not have that cash on your credit card, you will not be able to purchase what you need at that point in time. So the cash flow provides insight whether the company or business is on a solid financial footing. Cash flow allows investors to also understand your company's operation, how it's running, because you don't want to show negative cash. Like in your bank personal account, if it's negative, definitely you won't be able to do much because it's showing a negative cash flow. But if you have cash for your business, or even shows when it's going to be coming in, that too is a good management tool. And also investors use that to predict your inflows and outflows. Okay, next. Operating activities. This is the first part of a cash flow statement. The operating activities include sources and uses of cash from operating a business or selling its products or services. For example, in the lending business or line of business, our operating activities come from people paying their loans monthly, or someone paying off a loan. That's the cash coming in. So we can project if we know someone's going to be paying in 30 days, 60 days, or even paying off the loan. That's cash we can anticipate. Also, when we're making loans, once the loan is approved and we issue a commitment, we have to set aside that because the money is going to be going out to pay a borrower. So that's a cash that's going out. So that source would be limited for that, okay? So in essence, okay, someone asked if I can talk a little bit about business versus personal credit card. Okay, yes, definitely. For example, if you talk about business versus personal and the rational consider one. Well, definitely the business credit card, if it's used for business purposes, okay? Your personal credit card is for your personal use. Personally, I would advise people to not co-mingle. Meaning, if you have a specific credit card for your personal use, let it be strictly for your personal use. Do not co-mingle it with your business. But your credit card for your business should be reserved for business activities. The reason it's good to have that practice, it's a good reporting mechanism. Most business credit card will give you reports, and that's a good way of having a statement to show where your business cash is going, because your credit card is like your bank account for your business. So the cash that you have on your credit card, if it's solely for business, that's a good way to segregate and not mix it up, because that's I was referring to business and personal credit scores. Oh, well, I was talking about in terms of credit card usage. If you're talking about credit score, that's quite different. Credit scores, well, it's important, especially for small businesses. Your credit is very important. Credit score, as you know, is very important in analyzing businesses. A credit score is not separate from the business owner. Your personal credit score determines the risk and your capacity to pay back your debt, because the credit report is pulled as a way of telling your lenders if you can pay back your debt. Because even though it's not always the case, because there are different reasons, but that's just one mechanism for determining your ability to pay back. That's your capacity. But that your personal credit is important because it's used in evaluation of a business credit, especially if you are a small business. Usually credit scores are determined by what you have done personally. But after a couple of years and you have track record and have shown that you have the capacity to service your debt, your credit score becomes it's not a major consideration, because they will look at more of your track record from your operations for your business credit on how you service your business activities, okay? But normally, as a startup in the first 5 years, The credit score is a major part because it tells your capacity in servicing your personal debt. Okay, thank you. Cash flow from operations, usually it's in form of cash, accounts receivables, and payables, and inventory. Okay, so operation is a day-to-day operation where cash is coming in or going out. For example, income taxes. If you have to pay taxes, you want to keep that money to pay your taxes alone because you know it's due quarterly for small businesses. So that's something you project. Insurance premium, that's something if it's prepaid, you know when it's due, you want to set it aside. Okay. Okay, so let's continue right now to the next slide from operating activities. This is investing activities. Investing activities includes purchase or sale of an asset. For example, if you're buying a vehicle, a car, loans will be made, so that's an investment. So these purchases will be something that you project on your cash flow because you need to make sure that money is set aside, or if you are getting a loan, the loan's going to be coming in. And for small businesses that are coming through a lender, you know you have a projected revenue coming into for a specific reason, either to purchase a property or plant or equipment, and you will stick that on your cash flow as cash coming in. But as you pay off, that's cash going out. Okay, the last category of cash flow is, next page, is financing activity. Cash flow from financing is what I talked about earlier. It's money or sources from a bank or investments. For example, if you have a loan, we make a commitment to you, but you may not have the cash right away. It may be in 30 days to disburse, or it may be a week, but at least you know when that fund is coming in. So your cash from investor or banks will be used also, but if you have equity coming in from partners or other investors, that's something you would indicate on your cash flow and to say what the source. So it's like a sources and uses but it's in a short time at that point in time, okay? Well, the biggest red flag for lenders when analyzing these documents is to make sure that you are cash flowing, because bottom line, it tells the lender that you are on solid ground, you are performing, as well as you have the ability to service a debt. So the first thing a lender will look at is your cash or your income statement or your P&L, okay? Even if you are negative or showing a loss, then they will look at the balance sheet to see if you have a net worth, to see what's on your balance sheet in terms of assets. And so it's important to have those reports made. If you cannot do it yourself, make sure you hire an accountant or bookkeeper. Well, bookkeepers normally compile the reports. They normally do not do your financial statements. But if you have someone helping you, an accountant, they will be able to do your financial reports, but also help you restructure. And your cash flow is important because it helps you to plan. It's a good planning tool for monthly cash flows or quarterly or yearly. So these are important to lenders because they want to make sure that you are on a solid rock and you know what you are doing. But if you need help, you want to ask questions and do not tell the banker that you do not know, because if you do not know, definitely it's a problem, okay? So let's move on to the next, back to the statement. This is the end of the PowerPoint, but I want to go to the income statement and share it with you. Okay, so it's, Melissa, can you go back to the statement? It's going to say income statement. And we just share that example with you. Okay, great, right there. Now, this is an example of a company which is a contracting company. It is rather different for every business because you see some different wording, but the concept is the same in terms of every company has different um, line items, but the format is the same because the income statement is the income statement regardless of where you go. In this case, let's assume this is 2019 and 2018. They just lump out, this is, they have contract revenues. This particular company is a contractor, so they have contract coming in. 2019 was a good year. They made $10 million. 2018, it had 8.9. So you see right there, they generated more revenues, but that's not the end because it's not their profit. Okay, but the direct cost is the same. This is what it costs them to generate that revenue. In a service business or other retail, this is called cost of goods sold. The material, the labor, all related to this revenue was 6.3 million. Those were all, 6.3 was the direct cost. And then the gross profit is gross, it's not the net. But then the gross profit was 3.6 after the cost of good or direct cost for 2019. And then 2018, it was less. So you see the difference. And then they had a general and administrative expenses. And those would be like the payroll, marketing, and other general administrative expenses was 2.8. So once you subtract the expenses from the gross profit, the profit there was 774,000. So 775. So that was good. They didn't make a profit, and the year prior to that was 500,000. So you see almost a 200,000 increase in profit, and that profit is before taxes. So let's go up. Please take it up. And so other income was showing, and then the earnings before taxes was 687,000. So usually you have your earnings before taxes and depreciation, and that for it was 687 for 2019, and 2018 was 417. And provision for taxes, which is the taxes they were paying, were 23,000 for 2019 and 30,000 for 2018. So the net income is what is most important, because this net income is your profit. And that's what is also transferred to your balance sheet as retained earnings that you saw earlier. Okay, so please move down to the next chart real quick. And this is just a detailed schedule of the general expenses, salary, all the operating expenses. So let's move down. I wouldn't go through that. The last statement here is just show the retained earnings, and you see the 500, the retained earnings from the year before was 563, which was 2018, and then the net income was 663. So if you look back to the balance sheet, it would be a total retained earnings for 2019 was 1.2 million. So this is a strong company. I'm sure we wish we could use this as one of our borrowers. With something like this, we wouldn't have a problem. We know they have the cash flows to service the debt. So the next statement, please, is the cash flow statement. The cash flow statement, or statement of cash as it's called sometimes, the cash from operations showing the first line showing the net income, and that came from operations. And then 2019 was 663, 2018 was 386. And going down, you will see all the different activities. So those were different adjustments. And go down, this is strictly just operation, the top portion. And then after operations, Melissa, can you go down? Then after that was the net cash from operating was 1.3 million, which means the net cash after all of the operating adjustment and activities, cash in, cash out, came to 1.3 from operations. Then the next one was investing, cash flow from investment activities, the purchase of property and equipment. So the purchase equipment, 88,000 in 2019, and 2018 it was 122. And the net cash for investing was the 88,000. And the last category was cash flow from for financing, and that would be like a loan that he got, proceeds from note payable, and then payments on note payable. You see, the first one was 7 million. That was 7 million were proceeds, but then they pay out more in notes than they receive. So that's a negative cash flow from investing. So, but then if the net increase in cash and cash equivalent came down to 33, at the end of the day, December 31st, they had a cash and cash equivalent of 1.191 million in cash. So at least they know what they had in their balance as of December 31st, because this was done for the year. So with that, that's the end of my presentation. Thank you very much. And now we can open for a few questions because I have to exit briefly. I have another meeting to jump on. So, but you can ask questions now. I'm open to questions. If not, you can always email the questions to the host, Melissa or Bonnie, and they can get back to me. But the questions—
feel free to unmute yourself to ask your question. And after Watchen has to go, we'll do a little bit of a wrap up and we'll talk about Baltimore business lending, and we can continue to answer questions if you have more after that.
Okay, this is Deborah. I had to put a question in the chat, and my question was, what is the net effect of a business owner contributing its personal income to meet the financial and cash flow needs of the business?
You said the net effect of the business owner?
Yes. What is the net effect, on the, how does it show up on the business?
Oh, it will show as equity because you are investing in your business. So that's the owners, on your balance sheet. It's going to show as an equity because you are rather investing in that business. So it is what you are putting into that. So the net effect would be that you are putting your money in your business to support it, and will be reflected in your equity portion of the balance sheet.
Okay.
Where on the sample, it showed shareholders' equity. If you do not have stock and you have a sole proprietorship or an LLC, instead of shareholders' equity, you would say owner's equity.
Yes, right. That's the equity.
That show.
Yeah.
Okay. Well, I'm not sure about the stock. I mean, that's another whole question, but I don't issue myself stock, but I do.
No, it's just the money that you've invested into your business is your equity.
No, yes, right. So money you invest is the owner's equity. Stock is owner if it's a stock company, but in most small businesses do not issue stock.
Right.
You could also have family or friends investing in that business, and that would be also put in as equity in that portion. So it's owner's equity, as well as if you have investors and you're giving in shares. For example, I could be an investor in your business. If I'm giving you, even if it's 50,000 or 100,000, and I'm giving it, but I'm not getting cash back in return, it would be an investment in your business as a stockholder. And that will be reflected on your balance sheet as investment. But in return, they will get a portion of your business. You will not own 100%, because if you're selling 25% to generate cash, you will get the cash flow, and the shares will be issued to that partner or investor. Bob, you have something to add to that?
I do. Thank you. Thank you, Watchen. There are actually, and Watchen's correct, there's actually two ways to invest. One is pure capital, pure equity, which Watchen talked about. And then the second one is you can always, as a shareholder, have a note payable to the shareholder, meaning that you create a liability. So if you give your company $10,000, you would have an agreement with the company to pay you back that $10,000. So, there are two ways you get to the same point, with the exception of if it's a liability, you are getting something in return.
Yeah.
So, but Watchen's 100% correct. You can do it either through the equity or the liability side of the balance sheet.
Either debt or equity, right? But
Okay.
normally, if it's a debt, it would not be in the equity portion. It would be on the liability because you have to
Right.
pay it back.
Yeah,
But
well, I'm not
usually
at,
equity
yeah,
is
no,
shares.
yeah. I mean, I'm not asking for it back like that. If I draw a salary, that's my salary. But
No, the salary is an expense. It's not.
right, exactly. I'm sure I understand. I don't want to confuse the question, but I got it. You answered my question. I just wanted to know where to look for,
Okay, thank you.
Thank
Any
you.
other questions? But any other question, either Bob and Bonnie can answer that. I'm sorry, but I have to get on this call with an investor. And that's important for the company. I need to jump on. They need to talk to me today at 3.
That's right. You got to
So I need that to put on our balance sheet as our equity. So I'm sorry, but please continue to ask questions. Both Bob and Bonnie can answer your question, or even the loan officers. They are all on. I see Melissa and Dawn. They can answer your questions. So thank you all very much for participating. And I'm sorry, but duty calls, okay?
Thank you so
you,
much.
Watchen.
Get that
Thank you
money.
very
Go.
much.
Thank you so much. Though.
Yes, thank you. We're trying to raise more money to give you, okay?
Yes.
Okay, then bye-bye. Thank you, guys. Bye.
Great day.
One thing I would like to clarify about the balance sheet is it should balance. The key is in the name. You've got your assets and liabilities and equity, and assets is what you own, and liabilities and equity is how you paid for it. Liabilities meaning debt, and equity meaning cash of your own investment or returns on your earnings. So the bottom line number under assets should be exactly the same as the bottom line number under liabilities and equity. And if it's not, then you did something wrong in there. When I'm looking at balance sheets, people tend to try to turn them into a profit and loss statement because that's one of the easiest things to understand. Everybody understands profit and loss. And they tend to struggle to make that balance sheet look like a profit and loss statement. And that's where, when you start seeing the numbers don't match, then you know you've gone wrong. Do we have any other questions out there for now?
Yes, we do. Hi, this is Sophia. I actually had 2 questions in the chat. So the first one I was going to ask is there a specific percentage or a range that you should be hitting to let you know if you're running at a profit?
I'm sorry, what was the question again?
Is there a specific percentage or a range or percentage you should be hitting to let you know if you're running at a profit?
Well, I would say it's the profit and loss statement. If you come up with a plus number, you're making a profit. A lot of folks try to determine ahead of time what their profit margin will be. They're aiming for a 10% profit margin, or they're aiming for a 50% profit margin. It typically depends on your industry, because some industries, just by their very nature, have higher profit margins than others. A lot of product sales, like liquor sales, for example, tend to be 100% profit margins, and food and restaurants tend to be a tighter profit margin because you just don't make as much money off of food. So once you've what you're aiming for, then you can look at your bottom line at the end of the year and see how close you're getting to it.
Got it. So is it reasonable to say, like, let's just say a +5%? Because I guess because sometimes, as a business owner, we have this big, grandiose dreams of how much profit we want to make, but I don't know if it's realistic or not. And so that's why I want to know, regardless of the industry, if going into a business, it's okay to, to want at least a +5% margin, just, so that way you're not. Yeah.
So, Sophia, let me answer it a little differently. I think Bonnie's 100% correct. There's guidance out there as it relates to what your industry should be making as an average. So I'll just pick one. If you're in a restaurant business and you have revenues of less than $1 million, the ratio or the percentages would show that you need to make, I'm just making this up, 3 to 5%. So if you have a business that's less than $1 million, a restaurant, and you're making 3 to 5%, then you're averaging what everybody else averages. But there are indexes out there that will tell you exactly how much you should be making as a range anyway in the industry that you're in.
Got it. Yeah, that's
The
great. Thank you.
SBA has some information about ranges. They used to have something called the Size Up tool. I don't know if that is still available, but the SBA has some, and there's a lot of government information websites that can also, if you do your industry research, that will give you that kind of information that Bob's talking about. The SBA, if they don't have the information themselves, has links to pretty much all the other places that you can find that kind of industry information. And we're going to be doing a marketing seminar next month and talking about some of that marketing research. So it'd be good to come back and learn some more.
Definitely, definitely. Thank you so much. The last question I have is regards to depreciation value. I think when Watchen was doing the presentation, she was saying add in your subtracting your depreciation value for your fixed asset. Like, is there a way to know like what the depreciation value is for your fixed asset, or is there like, you know, again, maybe just a research where, you know, depending on what the fixed asset is per year, this is how, you know, how much it depreciates?
Well, it all depends on the asset itself. Typically a fixed asset will depreciate over a 5-year period. A asset that's not fixed, for example, software, for example, depreciates over a lesser period of time. So the easiest way of doing it, it's really just straight line depreciation. If you paid, I'm going to pick an easy number, over 5 years, if you paid $5,000 for it, each year you would depreciate $1,000 a year until it's fully depreciated.
And for a number of types of assets, the IRS establishes the depreciation terms that they accept for income tax purposes. So that's also a guide for, you know, specific types of assets.
Okay, perfect. Thanks a lot. Appreciate it.
Any other questions? Again, feel free to unmute yourself and just ask out loud. Okay, well, I'll tell you a little bit about Baltimore Business Lending, and then we will merrily send you on your way and hope you come back next month and join us for our marketing seminar. Baltimore Business Lending, as I said when we first introduced ourselves, is the small business lending division of Baltimore Community Lending. Baltimore Community Lending has been around for 31 years. They are primarily a developer and construction lender for developers in Baltimore City who provide affordable housing and community development and some commercial mixed-use development in underserved Baltimore City neighborhoods. And about 3 years ago, they decided that if they were really going to, you know, make a difference in neighborhoods, in addition to buildings, in addition to commercial space, they needed to help small businesses too. Neighborhoods need products and services. They need jobs. They need entrepreneurial spirit. So we added a small business lending division to Baltimore Community Lending, and we call it Baltimore Business Lending. And before we started doing that, we actually went out and did our research to find out what are the barriers to credit primarily in Baltimore City, because folks in Baltimore City have a much harder time getting loans than they do out in the counties. So we looked at what the primary barriers were. There's been a lot of research done. Calvert Impact Capital did a study. Johns Hopkins 21st Century Cities did a massive study about lending. The numbers were a little shocking. Small business lending has not even caught up to where it was in the 2008 crash, while lending to corporations has caught up and far exceeded that. Maybe that's not shocking to some of you, but it was certainly not good news. So we built Baltimore Business Lending around what we saw as the greatest barriers to capital. And in the entire, the number one barrier to capital was really collateral. Most small business loans require collateral. If you don't have any collateral or enough collateral, people they can't get loans, so they tend to use their credit cards, then they can damage their personal credit, and eventually it just gets tougher and tougher to get loans. So we are offering small business loans to startups from $10,000 to $50,000 and to existing businesses from $10,000 to $150,000 for folks who have reasonable credit, who have strong business ideas, but who may or may not have sufficient collateral or have other barriers to credit, like a credit score that's below 680, which a bank would require, et cetera. Some of our folks do have collateral, some don't, but we don't use that as a deciding factor. Also, we learned that while businesses can be very good at what they do, they make great pizza, or they sew wonderful clothes, or they have excellent freight delivery services, they don't necessarily know how to write a business plan or how to put together financials, or even in some cases, how to apply for a loan. Terms like assets and liabilities can be confusing for someone, even if they've been running a fairly successful business. So instead of requiring collateral, we require that our borrowers participate in a small business training course. Now, it's free and it's one-on-one. It's customized to your needs. Some folks, it's a couple of hours in a meeting, and other folks, it's months of figuring it out. It's totally your own pace. We work with other technical assistance providers, and we do it ourselves. And we help you get that business plan well thought out and written, and put your financials together like the ones that we talked about today. And then it gives you a much better, we think it's a much more equitable way to make loans rather than require somebody to own a house, but that instead anyone can go through free training. So we think it is more equitable. And we also think that in the end, it's going to make you a better business person to have small business training. So that's basically what we do. You can find us online at baltimorebusinesslending.org. And also Baltimore Community Lending, actually bclending.org is the Baltimore Community Lending website. If you are a developer or a contractor and are looking to buy a block of buildings and turn it into affordable housing. So we have sort of both ends of the spectrum there, and we make all business loans, and we would love to hear from you. We'd also love your feedback on this seminar, because now that we're doing everything by Zoom instead of in person, we've decided to do more informational and educational seminars from month to month. Next month will be about marketing for small businesses. The month after that will be about business planning and borrowing money. So we are really excited you could welcome us. I mean, that you joined us today. We will email these slides, the PowerPoint, out to the folks who signed up through Eventbrite. And we have recorded this. So if anyone would like a copy of the recording, just send us an email, and we'll send that out to you. It probably will not be available till tomorrow morning, but we can certainly send it out when we get it. So if anyone has any questions about Baltimore Business Lending or Baltimore Community Lending or anything we've covered today, we still have a few more minutes, and we'd be happy to answer your questions for you. Okay. So now we expect you all to have amazing financial statements the next time we see you. Always happy to help folks and talk things out. So call any one of us, me or Don or Angela or Melissa, and we're happy to chat with you anytime. Where you can find us on Facebook and Instagram and LinkedIn. And we hope to see you again next month. Thank you, everybody.
Thank you so much.
Thank you.
very much. Mhm.
Thank you. It was
Bonnie.
Great. Take care and good luck, everyone. Stay healthy.
You too. Take care.
Okay. You can stop the recording, Melissa.